All right. Good morning, everybody. Got a little bit of a bounce yesterday. Uh, Spot Gamma suggests that it's an artificial bounce from the adjustment of the JP Morgan collar position into the new quarter. Their take is that, okay, the bump got us moving in this direction. We lifted up off the lows, but now we don't have any reason to follow through with that bump with tariffs right in front of our face, and that we likely fade back down again. I mean, it's possible the tariffs are a really big unknown. At this point, my position on the tariffs are that we're going to get them, hopefully, right? I mean, we don't even know if we're actually going to get them. We're going to get the info, and the best outcome we could get is clarity that they're actually going to give us straight answers. They're putting them on or they're not putting them on, and the market goes higher from there because it finally has that point of view is based on what we've about the history with the market. It doesn't like uncertainty. The worst is once we know what the bad news is, if it's not shock and awe, something that just hits us out of the blue that the market didn't see coming, the market generally works around bad news, right? It gets it, figures out what it wants to do with it, and then it moves on. So are the tariffs good or bad? Not my place, right? That starts getting into politics, which point of view you want to lean on. But when it comes to what we can do with it, once we finally get clarity, we get some answers, I think this market can come up out of this hole. Now, I'm not saying we're going to go back to all-time highs, break into new highs, anything like that. I'm just warning against the idea that these tariffs are nothing but doom and gloom and that we're going to go down from there. I don't see it that way. And if you look back throughout history, when it comes to negative things hitting the market doesn't usually approach bad news that way, as long as they saw it coming in the first place. So kind of keep an open mind with your positioning, or another way they say it, know what you own, because if you're too heavily weighted to the downside and we do end up popping after we get the clarity from the tariffs that we're all looking for, get run the heck over. We got a bit of a mixed bag around the world. Japan down more than 0.75%. The small caps down 0.25%, and everything else for the US and Hong Kong and mixed between those. Europe getting a little bit of a rebound. If we look up to the upper side, you know, they had a bad news cycle, getting a little bit of a bounce. We are going to get data at 10 a.m. It's kind of a big deal, especially with this spread. So, you know, normally it's 8:30 or it's 9 o'clock when we've got news coming out that may impact the market. Today it's 10 o'clock. And this kind of feeds back to one of my statements that I use often that says, if we haven't broke out by 10 a.m., we likely won't until after lunch. If you haven't heard me say that before, well, you have now. The thing is, one of these days where we get data at 10 a.m., that's where the other half of that statement comes from. You know, that as long as we don't get any news. So at, 9:30, the market could open. We can do whatever it wants, likely goes sideways while it's waiting on data. After 10 a.m., it's game on. And this really is the kind of day that screws with those open range plays. There's a lot of strategies that use an open range, whether it's the first 5-minute bar or a 15-minute, 30-minute. I've even seen 1 hour open ranges. This 10 a.m. economic event screws with that data. It screws with the play, and just proceed with caution. Yeah. We've got the JOLTS numbers. That's the take this job and shove it numbers. The idea that the grass is greener, that you could leave and go to another job, and your perception on whether you think that would be easy to do or not. You know, if you remember back in 06, 07, 08, when jobs got scarce, you held on to the one you had because you're pretty sure you wouldn't find an equal or better job somewhere else. That's JOLTS. That's the easiest way to think about it anyways. We're going to hear from Europe later in the day, ECB lane. Really, by the time we get through lunch, get on the other side of that, we don't have anything left into the end of the day unless we get some, yeah, right there, unless we get something coming out of the White House. So we've got a press briefing and more executive orders. Looks like these are also closed to the press, but we saw that yesterday, and then the press secretary was feeding it out anyways. So it's likely the afternoon is going to be, you know, shock and awe headlines. So we'll just have to play that as it comes along. We have the 10-year moving to the downside, and as expected, the ES is starting to follow it. Wasn't quite sure we were going to get the move, but we are starting to see the dollar move to the upside. Watch this pivot. It's not, you know, at 104.5, which would have made things nice and easy. 104.33 or 104.35, whatever, it's close enough. Get through that, then we can challenge this high up here, which is a front run for 104.5. We don't really want that dollar moving to the upside, but more importantly, we don't want the dollar to make big sweeping moves in any direction, up or down. So if it's moving up, fine, it's moving up. Just keep your eye on it because we don't want it to make any really large move up or down. If it starts to do that, be more cautious with the 10-year and just tread lightly. We don't have the AM edition of the Founders Note yet, but I sent out the picture of the levels for the day, and you may have noticed that the call wall, zero gamma, and volatility trigger are all grouped together, that there wasn't anything in between them. That is something we haven't seen in a while. Usually we get something like a call wall, a couple of intermediate levels, and then zero gamma, maybe another level or two, and then the volatility trigger. Not now. Right now, we've got one level above all of those, a large gamma level. Otherwise, we've got the call wall, volatility trigger, and zero gamma, then some intermediate levels with the put wall all the way down here, and only one level below it. This one, 54.42. It's interesting that it's on a 42 or close to it. Way back in the day when we were using COGS and the ES was down in the 2800s and the 3200s, you know, as opposed to 56 like it is now. Been using COG lines for a long time. Yeah. There used to be a lot more lines other than just 11, 32, and 92. We had 42, 86, I believe, was another one. They didn't all make it over the years, but still keep my eye on 42. Be surprised how often that level comes up. It's just not a validated COG line. So we are holding above the put wall. It's lined up with yesterday's low. Breaking one would be breaking the other, basically. And I've been looking at a new tool which suggests, let's go to the SPX because I don't have ES levels for this, but it'll line up similar if we just think about the price action. We have a 55.90, which is 55.80 right here. It's Friday's close. If we break Friday's close, we can go to 55.50 relatively fast, that there's not a lot there to slow us down or to get in the way. Once we get to 55.50, we'd have to start climbing back up a hill of options Greeks. And so it'll be a lot more difficult to get to this put wall. That's not to say that we can't do it, just that it wouldn't be as easy going from 55.50 to 5,500 as it would be to go from 55.80 to 55.50. Overnight volume sitting at basically 140,000. That's pretty elevated, all things considered. We've seen this sort of elevated level over the last month or so. So if we look at it from that point of view, yeah, we're doing about normal. But if we were to go back a year ago or just look at things over the last few years, sitting in the hundreds at all is pretty extreme. We should have been sitting somewhere around 50,000 to 75,000, but we haven't seen that in 6 to 8 weeks. It's been these elevated levels. So they talk about how we're in a low volume environment in equities, but we're still seeing plenty of trading activity in the futures. Looking at the ADR levels for the day, we are closer to the lower one than we are the upper one. 55.91 cog line, 55.92. So it would be more likely that we hit that lower one before we hit the upper one. Also, the idea that we would have to break yesterday's high to get to this level, but we don't have to break out of yesterday's range to get to this level. We're also already down 0.5%. So from where we opened last night, looking at the midpoint between these two, we're closer to this one than we are to that one. So it's likely that we would get to that lower one first. It is sitting just below a round number. So front run, we've got a cog line 56.11 and then 5600 and then 55.92. That also means that we've got to fight through this structure that we built here. To get a full ADR would put us at yesterday's low. So we could get that done and still not get an inside day breakout. Today's floor pivot is lower than yesterday's. That's bearish. Price opened above it. That's considered bullish. Those two kind of cancel each other out. We had not hit that floor pivot. So base case argument is we are going to hit the pivot. Hello, kitty cat. Before we do anything else, markets tend to hit their pivot 80% of the time. So that's what we've got to expect at this point, especially after getting that close, right? That we would just go ahead and hit it. Lay down. We are underneath the weekly pivot. So any move to the upside, keep track of 56.80. It's going to be a level that we likely struggle to get through. The channel isn't as wide as it was yesterday, but all things considered, it's still a pretty wide channel. When we have a narrow channel, the idea is that we could really run if we break out. It doesn't mean that we will break out, just that if we did attempt a breakout, it could stick and we could just keep on going. When it's a wide channel, that is less certain. It's more likely that if we attempt a breakout that it doesn't stick and that we come back inside the range again. So today the channel is a little skinnier than it was yesterday, but all things considered, it's still a wide channel. We don't expect that a breakout would stick. Just remember, these channels don't make price do anything. It won't cause us to break out, and if we do break out, it won't cause the breakout to stall. We are working on a double distribution for the week at this point. The point of control is still at yesterday's levels, but if we make another run back up, it's likely that we'll see this point of control shift up to our position here. We had already spotted this area as a likely place where we could get hung up from this point of control and from the little bit of distribution that we had put in on Friday of last week. If we can get above 56.50, if we can now get above the footprints that we put in here, it's a shallow run back to this previous area, is 57.50. We just got to get through whatever it is we hung our hat on. Ten-day, 30-minute volume profile with TPO. Point of control is still overhead, matching on both sides. We can see we got a lot more volume across the high than we do trades. We're not expecting to see this point of control move anytime soon unless we get stuck around this 56.60 area. We're going to lose all of this volume here through the middle, which means we very likely lose our point of control's position. And with that in mind, it's very likely that the point of control shifts up into this 58.37 area. It'd be good if we can get through there first, but at this point, getting through 57.50 without getting the tariff news is unlikely. All right, we had this new VPOC from Friday. We hit it yesterday afternoon, so we're done with it. Yesterday's point of control, we've already hit a couple times, so we don't have a new VPOC for today, so we're just done with that. We've got 57.55 as the March 27th point of control, if we can get above that 57.50. These two don't exactly line up this morning, the point of control on each of these, but the profile is fairly equal. It'll do. Nothing really stands out as a warning or a concern. For the week, everything is fine. We're still sitting inside our range. Nothing really stands out. 57.09, basically. 57.10 to the upside, and 5,500 if you want a nice round number on the downside. So a 200-point range, basically, for the week. And we're nowhere near either edge at this point. 1.25% below the 10-day. If we get below 2%, then we'll start to have that discussion about getting too far away from the mean and maybe a talk about some mean reversion. But at this point, we don't have that situation. We haven't moved too far, too fast. It doesn't owe us any sort of mean reversion. And we are far enough away from the 10 at this point that we really don't even fit into its gravity. We'd have to get within 0.5% of it before we would start to think that it could get us drawn in there. And on the week, we still haven't even just completed the slope, right? All of this is a bit like a wave, even if it seems choppy, where we're just crossing back and forth. So we've made our wave to the downside. We're still just looking for that completion back up. We all know it's going to happen at some point. There has been times in history where we didn't make the wave and we just recycled another low before we finally ended up getting a move to the upside. So seems like we're in one of those situations this time. Just keep in mind, there are plenty of examples where we were deep below the 10 and then we weren't, right? In a single shot, we just crossed and was on the other side. So tech and financials are down this morning, with the airlines, a little bit of China, and that's really about all we have that is down at least 0.5%. And things that are up: bonds, Bitcoin, and the VIX. Bitcoin, pot stocks, bonds. That's not the kind of market you want to sustain a rally in the S&P or the NASDAQ. Although, if we're looking at it from a bigger picture, finally getting Bitcoin moving to the upside would be a good start, because it is an indication of risk. So, one morning doesn't mean anything, but if it sustains through the day into the overnight and then say into tomorrow, that'd be a good start for looking at a broader market move to the upside. It has to start somewhere, right? Even in the riskiest of the groups. And then, of course, bonds up. This is not helping. We can go back to this with the 10-year breaking down. Bonds are moving up, and as you can see, with the 10-year moving down, so is the S&P, which means if the 10-year was to start moving up, the S&P would start moving up, bonds would be moving down. So we don't want bonds up. We want yields up. And we've got multiple types of bonds that are up this morning too, right? Not just TLT. %28 of the S&P is down 0.5%. And 25% of the NASDAQ is down 0.5%. Much less negative than it was yesterday. And we look at some of the names that are down this morning. We've got a lot of chips or semiconductors that are down. We know that's one of the hyperscalers that we like to see, but really it's a part of the Mag 7 group. So if we wanted to see a rally in the S&P or the NASDAQ, we definitely need the chips to turn around, but we need a lot of those Mag 7 names to turn around. We can see Facebook, Amazon, Apple, and that goes to the heart of the Mag 7 group. So every day we have the opportunity to get a rally in the indexes, and it can come from the Mag 7 or the top 3 risk on sectors: financials, consumer discretionary, technology. So it can come from that, right? The broader equity market on the growth side can fuel a rally and a breakout. And we can see that in the pre-market, which is why I always like focusing on that. But if we don't have that, we could also get a rally from zero-day options or intraday options plays in the indexes, but we can't see that in the pre-market. We could get a push and a breakout from news. We already talked about where the news is for the day. That just leaves surprise news that we couldn't see coming because it's a surprise, so we're not going to see it. And or treasuries. And so far, if we look at treasuries and FX markets, we've got yields going down, and that's not going to help, right? So we would need that to flip around, start moving up. Other than that, the only other thing that we could look at would be commodities, and commodities isn't enough by itself to get the S&P and the NASDAQ to break out and run. So at this point, if we're going to get a breakout and a move today, we've got to see one of those situations change. Until then, that's what I got, guys. Careful, be safe, watch the clock. I'll see you.